For a while, we were dealing with a market where bad news was good news and good news was good news, but today we got some good news and the market didn't take it all that well. We're going to talk about that and take your questions on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. We're looking at a situation today where, the futures were up pretty significantly early going. In fact, if we take a look at how they were doing in the pre-market, right after we got some economic releases around 8:30, they caught a bid, traded negative, and ultimately we ended up essentially flat on the day. So what's going on here? I'm going to just comment about this while I throw something up on the screen so you all can take a look at it. And I'm going to make this as big as I possibly can so that it's readable. And then I'm going to leave it alone for a moment so you can kind of get a look at it. There we go. I think that's good enough. All right. So as we take a look at this, the jobs data, I think we can safely say, was stronger than anticipated. We can see that that's the second line down here. The survey numbers, expected number was for an increase in non-farm payrolls of 65,000, and the actual number, 130,000. So 50,000 better. We take a look at the change in private payrolls. Once again, survey, pessimistic versus reality. Got 172,000, 68,000 anticipated. In the midst of all of this, we did see, and I guess this would be a potential negative, and that is over here, we're looking at the average hourly earnings. Now, in one sense, this is good news, right? In the sense that if you're seeing median incomes or average incomes rise on an hourly basis, all else equal, that's a positive. But I think that people who are inflation hawks would look at that and say, uh-oh, that's a potential inflationary pressure. Remember, for those of you who watched Office Hours with me and Mark yesterday, I had the Trueflation site up. And the Trueflation is more of a real-time measure of inflation, whereas a lot of the other data that we get from government statistics tends to be much laggier, just due to the way they calculate it. So some things that they calculate in the inflation data, for example, the housing costs. Housing costs tend to lag significantly. What we've seen is that in several major cities, rent costs has actually gone down pretty quickly. But that's not really reflected in the government data statistics. They have a rationale. The rationale is that, you don't sign a new lease every day. That is true. But really, when you're trying to, in my view, trying to establish the level of prices on a relative basis today to where they were 3 months ago, 6 months ago, a year ago, it really is where the offer is now. In the same way that you could say, well, people don't buy a new car every day, right? But that doesn't mean that if the same car costs $35,000 today and it cost $40,000 this time last year, that we're going to slowly work our way from 40 to 35. No, the price has changed. It is now 35,000. Yes, some people overpaid, or maybe they overpaid relative to what the price is now. But I think whether the item is large or small, or whether that is an item that one buys immediately, or typically buys and then there's a long time before there's a price adjustment, it's really the current price for someone who would go out and buy a product, a service, or pay rent that they would incur today that is relevant. So those Trueflation numbers, to my eye at least, are more reasonable. So really, this number right here, what this is telling us is that, wages are going higher. So if the Trueflation number on inflation is good, if that's better than sort of the headline government statistic, and that this is also a more current number, then that's a net positive, because what we know is that basically from 2021 onwards, prices increased faster than wages. So the real standard of living for most working Americans actually declined over that time frame. We really want to see the inverse of that. We would like to see prices stabilize. Maybe we'd like to see some prices come down, and we'd like to see wages rise. and that would reflect an improvement in the quality of living. You can see this. So this is another interesting statistic here. So you can see that the hours worked, they ticked up just marginally over the survey number. Unemployment rate, consistent with additional job growth, but the unemployment rate, that number is a little bit lower. This is also a bit interesting. So the labor force participation rate ticked up just marginally over the survey. And I also view that to be a net positive. We saw that the underemployment rate dropped. In general, this is all a positive. So why did the market respond in such a tepid manner? Well, the answer is that when you make everything about monetary policy rather than just the economy, everybody is really deciding whether they want to buy or sell risk assets, not based on the underpinning fundamentals, but instead based on what they think rates are going to do. And if job growth is stronger than expected, if wages are better than expected, what is going to happen is your expectations for future rate cuts are going to decline. That is to say, your expectations for cuts is going to decline, and short-term rates are actually going to go a bit higher. So if we take a look at this, that's essentially what we're getting right here. You can see that the 2-year rate ticked up a bit, and actually if I just go over here to look at essentially the entire fixed income market, what you're going to see is that bond prices in general, long dated and short, bond prices fell, which means that rates across the curve rose. And really, this is in response to that. What we saw in the equity market is in response to what I think we should actually all feel good about, right? So we want to see stronger than expected employment. We want to see real wage growth. And so, to me, this doesn't really undo anything. If anything, I am more supportive of this. And the reason is that the thing that I would get concerned about is if we saw rates falling because we thought more aggressive monetary policy was going to be necessary to at least keep the economy upright, to keep it from capsizing. Instead, it seems like the broader economic data is generally pretty good. And that's good news if you're hoping that at some point we are, for example, going to grow our way out of the debt, that we are going to stabilize and maybe begin to shrink the Fed's balance sheet. All of these are things that we need. We need economic growth to do that. These statistics, were they blockbuster numbers, overwhelming? Not necessarily, but they were positive, and they were generally positive on more than one metric, although they're generally related. So, yeah, I figured we could just start off with that before we got to some of your questions. One other thing, and I want to just offer this. So one of the things that I have gotten recently were a couple suggestions in the comments with respect to unusual whales, with respect to using large language models on the fly to compare my insights to Mark's insights to, broad approaches. These are all excellent recommendations. Thank you very much for that. Keep them coming. The request that we were going to do more displays with unusual whales, I thought to myself, well, maybe better than committing to say, okay, I'm going to use it, would be better to invite somebody from Unusual Whales onto the live stream to drive it and talk about it while I talked about some of these other things as well. So I actually reached out to them, and they are going to convene internally and hopefully identify a slot where they'll be able to come on and do that. So in advance, we'll make a note, and we'll be sure to put it into the next live stream description when we're going to do that, so that anybody who happens to be interested will be able to, to take a look at that and possibly ask some questions in real time. The other thing is that by doing that, hopefully it's going to be, we'll call it relatively evergreen content. So even if the stocks we're talking about aren't going to be as relevant, that it can serve essentially as a reference for people who are using the platform and want to learn more about how to do that and use it effectively. So I just figured I'd give that a mention. And it also points out that when you make suggestions or comments in the chat, I definitely try to take those things to heart and figure out ways that we can incorporate that into the future. Okay, with that, I'm going to take a few questions here, and we'll take a look. So the first one comes from Jim Howard. And by the way, Jim Howard, you have added some meaningful and helpful insights, so appreciate your feedback. We'll certainly try to do that. So let's take a look at eBay, which is what you're asking us about today. Hi, Mike. Thoughts on eBay? Did I put that up on the screen? Yeah, I think so. Hi, Mike. Thoughts on eBay? Wondering if it's getting thrown in with SaaS-type stocks despite falling under its 200-day moving average based on the 12-month. Fundamentals look stalled. Might have base at around 79-ish to sell a put. Okay, so I don't know. I mean, so let's just talk about the fundamentals first. And hopefully this is visible enough that we get a look. I'm trying to blow these numbers up so that they're visible. And then I'll indicate, not move around too much. So this is the last 4 full calendar years of revenues. This is the last 12 months of revenues for the period ended at September. So we're going to be getting the full year information any minute. And this is the forecast numbers. This is the consensus for this fiscal year, this calendar year that we're currently in. So let's just take a look at some of these numbers. Not telling most of you anything that you don't know about me already, but my first requirement, this one does satisfy that, which is that if I'm going to look at a set and forget, and that's not what you're doing because you're talking about selling a put, but just if we're looking at stocks first, and then we'll get to the option strategy. We are looking for, revenue growth in the neighborhood of better than GDP, better than inflation, the higher of the two. We're accomplishing that. I think regardless of the inflation assumption that you use, at this point, it's looking like the number's going to be well less than 5%, probably well less than 4%. Even higher figures are probably in the 3.5%, and then if you look at trueflation annualized, it's actually almost stabilized at maybe less than 1. So this part is good. We are looking for situations where EPS growth is faster than revenue growth. It is arguably not quite as compelling, 5.5%. So my thinking on this is that the CAGR, so the compound annual growth rate for S&P earnings per share growth, is over the course of the last, we'll call it 10, 15, maybe even 20 years, very close to around 8%. And historically, so going back a longer period of time, it's in the 6, 7%. So when I say a longer period of time, I'm saying let's go all the way back to the tail end, before I was alive, immediately post World War II, that kind of time frame. Still, this is acceptable, maybe even a little bit more acceptable when we see that you're getting, decent free cash flow, anticipated at almost $2.7 billion on a $41 billion enterprise value. Free cash flow yield being a number I like to look at, that comes out to better than 6%. That's quite good. Also, when we take a look at the forward earnings multiple, we can do this by taking the market cap or, fully adjusted. This is probably a good number. You can look at it on a fully diluted basis. I haven't taken a look at their employee comp dilutive effects or anything like that. But, if we simply take the adjusted EPS of $5.77 a share, also starting to get pretty inexpensive here, trading at 14 times. 14 times forward earnings, not too bad. So I think the next step then is to take a look at some technicals and see where we're at from that perspective. So first, we'll just screen through a number of the different ones, and I'm only going to take a look at the better performing ones. We can see that the better performing technical indicators, the top 3 at least, are all bullish. MACD is negative, buy, hold. We ignore this because that's not a technical indicator. That's just there for comparative purposes. But a little bit of a mixed bag. But generally positive, so we like that. Now I like to just take a quick peek at the chart, see what we're looking at. We're bouncing on or around the 200. Where did we close? 82.88. So we actually closed below the 200. That's just a little, we're not enamored of that situation. Let's expand this a little bit more. You know, we've had a couple situations where it's kind of bumped up, you know, blown through and bumped, but this doesn't really count because this was the Liberation Day business. So, you know, we went through here and we're through it again, which is a little bit annoying. On the other hand, in terms of valuation, we've got this level right here going back 5 years now, almost 5 years, back to 2021. So I kind of see what you're getting at from that put sale perspective. We're going to take a look at vol in just a moment. Let me just do a 5-year this way. What was your number? Did you have a number? You were looking, yeah, so you mentioned that it fell under the 200, 79-ish, base at 79-ish to sell a put. So very interesting. It does appear to me, you know, the way my eye sort of sees this, that we are getting to a potential level. Now, we had some, do we have a little bit of a remaining unfilled gap in here? That would take us down into this neighborhood. It looks that way, yeah? Not that it matters that much from a fundamental perspective. I mean, if we have a general sense of where we think we would like to accumulate shares, bottom ticking it is not really the thing to concern ourselves with. But that's $78. Okay, so I'm getting along with this idea so far. Let's see where vol is. Maybe we'll look at 2-month implied volatility. I'm going to get rid of the price chart in this case. All right. Well, this is, as we just pointed out, we're waiting for the full year numbers, which is one of the reasons you're seeing this elevated implied volatility here. But let me expand this. I want to see just how elevated that is. Is that a really good... Ooh, look at this. Aha. Okay. Juicy. 40% implied vol. Mean of 31.9-ish. Standard deviation of 5 and change. So we're, you know, 1.5 off the 5-year. And we are way, way high on the 2-year. So that must mean that the options market is anticipating a big, big move off of earnings. And that's coming up a week from today. So, you know, I think I've mentioned this more than once. I'm not usually crazy about selling premium going into the earnings print unless there's really a good and compelling reason to do it. The rationale for that is that unless you really are following the company very, very closely, you have some, you know, meaningful insights that are probably not common. I'm not going to say inside information, but let's just say that you are more informed than the average bear. That you will never know less about a company typically. I just got through saying this actually on an X Spaces earlier today. You know, we're never going to know less about the operating performance of a business than right before they report earnings, because whatever we've heard from the company before then has gotten about as stale as it's going to be, and we're never going to know more than immediately following. So the question one wants to ask oneself then is, okay, am I willing to roll the cubes and take a chance going into the print that maybe the news is at least a push and possibly better than expected? Or do I think that maybe that news is potentially going to take the stock down fairly substantially? Well, let's take a look at how this has happened in the past. So one of the reasons the options markets are implying such a large move is that the last two earnings prints, if you can see it right here, we've gotten some big ones. So when they reported their Q2 25 numbers last July, the stock was up 18%. And then when they reported the subsequent quarter for, that ended in September, stock was down 16%. And as we take a look at the chart, let's see where we are relative to those moments. Okay. So effectively, this was that big bit of good news right here. And here's the big chunk of bad news right here. Didn't quite take us back to that level. And it's, so that's, I guess, and maybe that's what you're looking at, Jim, is that indeed that's kind of right here, again, which happens to line up with all those other technical levels, that happens to correspond with, we've gone nowhere. We've done nothing. So we got some information that was better than the street had been expecting. Then we got some that was a little bit disappointing. Net at 78, 79 bucks a share, you've done nothing. So yeah, I mean, I think actually this could potentially be worth a shot. Let's take a look now at what the straddle has for us. So the straddle that expires at the end of next week. Ooh, well, those prices are a little wide. I'm guessing that probably is closing prices. If I looked at these 15 minutes before the close, I'm hoping these were tighter than they are there. Let's take a peek. So the stock was 82.88. We'll look at the 82.5s. 95 cents wide, and geez, the puts were well over $1. Let's take a look at what the prices of these things were at 345. Use your limit orders, folks. Don't put market orders in for something like this. Okay, yeah, they were tighter. Not tight, but they were tighter. 70 cents on the put side. I'll take the mid on this one at $3.50. Makes sense. And as we take a look then at the, I don't know that this really is important, but why not? We'll just double check. So now, again, I'm just going to go to 15.45, see if we have slightly tighter spreads. A little. Call it $4. All right, so we're at $7.50 on 82.5 or 83. That's interesting. A 9% move is bigger than the long-term average, but it's smaller than the last two. Okay. So let's see here. Let's take a look at the term structure, get a sense of how that looks. Listed. I'm going to go by tenors because I want to be able to compare like for like. And we're going to compare what eBay is looking like right now to how it looked a comparable amount of time before their last quarterly earnings release. So the last earnings release was October 29th. I'm assuming that was post-close, but actually it's not that important. We're going to go to the 22nd. That's a week earlier. And okay, so we got this in white. And there we go. So how far back was that? All right. Okay, I'm going to need to shrink this so that because I can't see what I need to now. So I apologize. I'm moving this stuff around on you guys. And you know what? Let's add one more for good measure. Let's go back to their Q1 2025 release as well. That was on April 30th. Okay. So what I want then is going to be the 23rd. Okay, so we've had two big moves, and vols generally are, now it's pretty clear that they weren't expecting moves quite this big, because like I said, we just calculated that the expected move is about 9%. These two prior numbers were substantially lower than we find ourselves right now, and the two moves that followed it were substantially larger. So the question we need to ask ourselves now is, I kind of feel like, all right, so we got good news, shot up, less good news, gave most of that gain back. Now options markets seem to be a little bit antsier. I'm kind of with you on this put sale thing, frankly. I think that could be a decent way to play it. So now the next question is, do you want to sell right up here in the front, or do you want to go a little bit longer dated? And of course, those short dated options are going to lose all of their extrinsic value by the end of next week, the ones that expire on the 20th. So that's a positive to doing it that way. But I think that these next expirations, because what's going to happen is you're going to get vol coming in pretty precipitously. So what are we interested in now? Well, let's take a look at what those two prior earnings, what did the vol surface look like after they reported? And so for that, this was a week prior. Now I want to go a week after. So instead of, so we're saying that they reported on the 29th, we're going to go to November 5th. So here's the November 5th vol surface in red. And this one goes over here. All right. So you can kind of see what happened. Actually, these ones didn't come in quite as much as you might expect. So this is the 2 month. This 2 month looks like kind of a good spot, right, to be in. You got a lot of Vega to come out. So we're at 40 vol here. I don't know whether the average between these two is a fair number, but let's just use this, which is a more conservative approach, and figure it's going to lose 10 clicks of vol. So where does that leave us? Let's find a put to sell. So technical's a little bit of a mixed bag, but generally okay. Volatility is elevated. I'm pretty sure. All right. Okay. Should have had this loaded up, folks. Sorry about that. Making you wait for my applications to load. Not necessarily all the fault of options play either. I run a lot of crap on this thing. Come on. All right. While that does whatever it's doing, I am going to just go like this. We'll just go to the options market, find something mid-market-ish. Let's go out to... So it's that 2 month vol that I think is going to give us a nice blend of theta, Vega, and also a buffer, by the way. So let's just take a quick peek at this. I'm going to look at the Feb 20s first. If you sell the 79s, let's just assume you get a mid-market price. Just know that this bid-ask spread, use your limits, as we were just saying, is probably going to be somewhere in the middle. So we're looking at like 180 a contract you might get for that. So we punch this out a little bit, get out to the end of March, maybe. April, you could conceive of. Look at that spread. You're killing me. You know what? I'm gonna look at April just because I think it's going to be a tighter spread for us to look at. So these 77.5s, you can probably get those off at like 290. So those might not be too bad. So I would think I would probably favor an earlier expiration personally, like those March 27s. But if you see a spread like that and you try to get into, a mid-market limit and you're not getting lifted, yeah, you can maybe go out to April or go to the March regular ways. They'll typically have tighter spreads. And, you know what we can do? We can do a little bit of... All right, so let's just take a look at this. I'm just going to ask you guys to keep a couple numbers in your head. You can pause, jot it down, do whatever you like. So remember what I said. We're looking at an implied volatility of give or take 40. Okay, so that's for April regular way. We'll now look at the March regular ways. We're going to do a little triangulation here. March regular ways, these are like 45. So what might the March 27th expiration volatility be, assuming that there's kind of a smooth surface? Is 42.5 a bad number? 43? It's going to probably be a little higher than the midpoint because it's closer to 20 than it is to March 20th than it is to April. Let's call it 43.5 volatility. Okay, and that seems to be approximately what the system is coming up with for us here. I don't know if you can see this, right? So we're going to use 43 as a number, just for giggles. Now, I'm just going to show you something. I don't think I've done this before, but I might as well at this point. So let's just say we're looking at the 79 level, which I think was something you know. We'll put 43.5 in here. What's a fair price for that option? So that's the theoretical value you see right here, $3.14 a share. Okay, so make a note of that. So 314 would be probably a reasonable price to get this thing off. 314, 315. It's a 34 delta option, which means that the price of that option, it's not going to be much decay between close of business today and opening tomorrow. So now you can use 82.88 as your reference price. And what you can do once you have this, and this is actually very common. This is actually how when we were shopping orders in vol space, interdealer layoff type of stuff. If we needed to buy or sell options, in a big block, to lay off risk or do whatever, we would shop the order around and we would shop it delta neutral. And that way you have time to work it, right? So what we have now is, what did I say those options are worth? So the options price is $3.14 a contract. So that's the contract price. I said the delta was 34. And I said the reference price was 82.88. Now, and that's actually these are puts, so that's actually a negative delta, which means it's going to move in the opposite direction. So now I can actually calculate what that option is going to be approximately as the price changes, right? Because I know what the delta is, I know what my reference price is, to essentially be paying, give or take, the same implied volatility. So let's just say that I wake up tomorrow and the stock is $84, right? So I can take the difference between these two. I can multiply it by the delta. And that is the new adjusted price of the option that I would anticipate. Okay, so then I know I'm getting kind of a fair deal. And now I can essentially do that work for any price, right? So you can build yourself a little calculator like this. And you can say, well, what if the stock opens at 81? I should be getting 378 an option. If it opens at 80. If it opens at 85. So you don't need to do too much modeling, but it's a good sort of rule of thumb to say, did I get a fair price? And normally I don't do this because normally I'm not looking at options that are the way these are, which is, as of the closing prices, these stupid things are $4 wide. So we kind of need to know what fair value is so that as the underlying moves, we know how to keep our limits in line, right? So I didn't really expect to have that conversation, but hopefully you find it useful. That's a good way to think about it. All right, I spent a lot of time on that. Steve Garcia, collared my Vale shares last week, April 1815, cost basis of 12. Okay, stocks run up a lot lately, but curious if you ever tweak collar trades or roll them out. Answer, yes. Yes, I do. So here's how. We just, so how do we do these collar adjustments? We actually just did one in good size, by the way, in Iron last week. So we have a pretty good position in Iron. How much do we own? Boy, everything's so fast today, huh? Yeah, so we have about, we have 900,000 shares of it, which is just shy of $40 million worth. Last week, they came out with numbers. Numbers weren't great, but the position was collared. We were short upside calls, and we were long downside puts. And let's do this. Let's just take a look at it over a little course of time. And the puts that we were long, and I'm trying to remember what day I was looking at this when we rolled it. I think we rolled it on Monday. I'm pretty sure we rolled it on Monday of this week. But we were, we were short calls up here, long these puts. Stock rolled over. We rolled, and the stock rolled down. So what did we do? I don't think we adjusted the call strike. I think we left that alone at first, but we rolled the put strike down. So then we were into the 44s, and then the stock went down some more, as you can see here. And then I think at one point we rolled to the 32s. So basically monetizing those puts, right, as the stock goes down. Because here's the thing. If you don't monetize your hedges when the stock comes down, but your long-term view is bullish, it must be. You own the stock, you're collared, right? So your long-term thesis is bullish. If you don't monetize the puts on the way down and do a reset, so you take some of that money off the table, when the stock eventually recovers, there was no utility in you ever having done this. You never realized any benefit from the hedge, and you may very well still be short that call. Now, at this point, over here, that call, because it was relatively short dated, was essentially worthless. So we covered that. And now you can actually see, what our position in this thing is right now. So now we're actually in a tight collar, which I'm going to show you, hopefully. Hopefully. So here we are. So what do we got? We covered these. This one, I'm not sure why we had the longer dated one. That could have been a keying error, because I don't think we would normally have. Actually, no, this should be right now that I think about it, because these options all expire on Friday. So these may be adjusted. So there's going to be some transactions. There may have been a keying error. But the quick point is, now the stock was trading 41.5. We're long the 40 puts and we're short the 44.5 calls. So the short version is, you collar your stock, yes. Do you make adjustments? You should. You should monetize those things, especially when the stock blows through your long strike, and just roll down. Because the benefit at that point, think about it this way: at that point, you've gotten the benefit of the hedge. You effectively have hit the pause button on your position. So if the stock recovers, you're not going to get that money back unless you roll that hedge down. So you should do that. Now, what's the downside? You would say, well, of course, that makes perfect sense. Why would there ever be a reason not to do this? Well, when you roll down, there's going to be presumably more extrinsic premium in the option you're rolling down to than there is in the one that you already owned. Because if it's gotten really deep, so you can imagine when we rolled from the 44s to the 32s, that's a big difference in moneyness terms. The stock had declined quite precipitously, as you saw in the chart that I just showed. But it's worth paying it, right? And in fact, that worked out really nicely, because in Iron's case, it did indeed bounce back a bit. Not back to where it was, but it bounced back quite a bit. So, rolled down, got down to the 32s, and then as the thing came back up, they actually rolled those put strikes back up again. So from long the 32s, having monetized on the way down, this way, right? And this is something you can do when it goes down, because you're long gamma, right? This is when owning options turns out to be a big benefit, because you own that convexity. It gives you, for lack of a better word, gives you optionality, right? So short version, yes, roll it. you looked into rolling into June. Okay, that's a different thing. The example that I was just talking about is not about rolling out, although you could, presumably. In our case, we are just dealing with some choppy near-term volatility and rolling up and down, not up and down and out. Right? So you can do that, of course, and the circumstances will help dictate whether that makes sense. Here's the problem, is that in your case, you're going out to June. What's June got in it? It's going to have a lot of extrinsic premium. Why is it going to have a lot of extrinsic premium? We're still in mid-early February, which means that by definition, there's at least one big and probably more than one big catalyst for Vale between now and then, because there's going to have to be at least a quarterly earnings release, possibly two, and so on, right? Okay. So I'm like, after these reports, do you think the market still see 2 rate cuts? Well, we need to get a little bit more data, and I'll allow other markets to sort of handicap that. I mean, there's plenty of things out there to, talk about rate cuts. I still believe that the short end of the curve can come down if stuff like, inflation now, trueflation numbers are correct. And I kind of feel that they are. As we see improvements in productivity, then we should actually start to see prices begin to stabilize. And there's also a sort of a measure of expectation in there. I think that the rate curve should also remain relatively steep, which is where we're at right now, because we have now gotten, several sequential bits of economic data that have generally been positive. So I still think that we could get and still deserve possibly that the near end of the curve could come in a little bit, because I feel like the inflation data is more volatile than government statistics indicate, and that immediately inflation rates seem to be a little bit better. I think that would be also more stimulative, and that's also a positive. Won't do much for the housing trade, I'm sorry to say, because I don't see a lot of justification for the long end of the curve coming in right now. But in general, I think it's good, and I think another rate cut would be okay. But we got to monitor the inflation data to keep an eye on that. Sold SMCI March 27th, 28 puts for $1.41 today. Thoughts? Kind of wish Mark was on for this one. I think he had some thoughts on Supermicro. My only issue with Supermicro, so some of you will remember, and actually, we've played around with these, LLMs. Why don't we play with one now? Some will remember that there was a little bit of controversy about Supermicro a while back. Let's do this for SMCI. I don't really like situations where you have these. So one of the things that I remember was that there were the suggestions that I saw was that there were these sort of non-arm's length transactions. And now this is going to help us reveal when that took place. Yeah, so this was August of 2024. Makes me a little bit uneasy when I see this kind of stuff. So that's the kind of thing where, there's smoke, there's people howling about it. Am I going to reinforce the narrative that there's something sketchy going on here? No. But, when you see things like their auditor steps away, and of course, a lot of times this also means that things can get corrected, right? But for that reason, it's one of these companies that when it has popped up on screens of mine in the past that I have just chosen to ignore it, because I sort of felt like, well, if there's 30, 40, 50 other stocks in your screen, and this one kind of makes you a little anxious, why bother? So that's just me, right? It's, no judgments, just telling you where my own head's at. But aside from that, if we then turn around and say, okay, well, I want to take their financials at face value, the growth rates are still, looking pretty good, right? That's kind of hard to argue with that. This part also, many of you will know, is something I'm not crazy about. So a lot of these plays, oops, I'm in the wrong stock, sorry. Had it up there, I think I had it on a different tab. A lot of these plays which are hardware based, so again, numbers quite good, but this was the part, and it was the cash flow number that threw me, because I knew they had some forecast negative cash flow, but the numbers I was just seeing on IREN were, and actually there's some relationship here, because what is IREN? There, it's a data center play, so there's going to be some relationship. The negative free cash flow is also something that I'm less crazy about. As I've pointed out before, for those AI plays where I feel like their organic free cash flow and EBITDA is easily sufficient to finance the sort of CapEx that they're investing in AI, that the way I like to think about it is, if this all turns out to be a fool's errand, what are they really giving away? So in the case of Alphabet, maybe that 60, 70% of 1 year's earnings is what's get blown. Same thing in Meta. Yep. So, but otherwise, the numbers look good, and so you can feel perfectly free to ignore my prejudices about complaints that came almost 2 years ago about the company financials. But there was that kind of non-arm's length transaction thing that always makes me a little queasy. Okay. Hi, Mike. You had mentioned on Monday's open mic that you had another channel that talks about the YieldMax ETFs, and you can ask questions. Where can I find that? Thanks, Sicilian Ambassador. So first things first, for anybody who is interested in asking about the YieldMax stuff, what I strongly encourage is to participate on the Wolf Trading X Spaces that takes place every Wednesday at noon Eastern. 9 o'clock a.m. Pacific time, because that doesn't only just include me, but it didn't today just because people were a little bit jammed up, so we weren't able to get somebody else on. But our intent is always to bring not just me in, but to bring traders in as well, and they can talk about what they're doing in near real time. They can't obviously talk to you about working orders, but they can talk to you about what they did yesterday, the day before, what they were thinking, what they were seeing. And so I think that's pretty helpful. On top of that, we are going to be releasing a new segment that just talks about those things. But this is sort of more of a forum outside of that. This predates any of the work that I do on behalf of YieldMax or Tidal. So I kind of want to make sure that I keep it open to the existing audience for that purposes. Besides which, when it gets more formal to talking about those funds, it sort of imposes some additional compliance restrictions and things like that, because we're talking about a regulated entity, we're talking about registered investment companies, and what I can and cannot say can and shouldn't be. This is just an educational channel over there. I don't want it to be turning into something where people think I'm making recommendations to buy or sell securities. That has this has different hair on it from a regulatory perspective, and I am, after all, a regulated person. So I share my views. Live forum like this can just tell you what I'm thinking, but and I guess that's an important reminder, right? So whatever I say, it's not a solicitation or recommendation or anything like that. Just what's on my mind. Okay, let's see here. FinWest. Hey, Mike, thanks for getting a rep from Unusual Whales to make a presentation. I'm a subscriber via your discount, but I feel I'm not full value. At some instructions will be great. The thing about that platform is that it's a very rich platform, and it gets richer every day because these guys are market participants. And so they're always, this is a good thing and it's a bad thing, right? So the good news is that means it's always improving. And, they're using it and deciding what works and what doesn't. And that's all great. The bad news is that it's a continuous learning curve because you're always trying to keep up. Look at the Bloomberg terminal. This thing, coded in Unix or whatever it was, and it looks pretty much the same as it did the first time I ever laid eyes on it. It has certainly become a much richer product, but from a look and feel perspective, it's largely unched. Yeah. So, hi, Mike. I replaced my hood shares with a risk reversal. Long the April 80s, short the March 1. Okay, long the April 80 calls, short the March 110 calls, and short an 80 put. Can you just verify that those are the right strikes? So you're long the call and short the put of this on the same strike. So that's a little. Yeah, they're different date. No, I see that these are different dates, but so that's I would probably so that's more of a calendar. It's more of a calendar spread in a way, even though you're dealing with puts and calls. Yeah, I'm going to show you what this looks like in here. So we're going to pull this up. So normally I would probably, a calendar is fine. And you kind of got a couple different pieces moving on here, but let's just take a quick peek at what you got. All right, so if I'm reading this correctly, you are short the 80 puts. Let me double check. In March. You are short the 110 calls, again, in March. And you're long the April 19 calls. Hopefully I got that right. Let me just double check. Oops. Nope, not the 90s. Where did I put 80s? So let's see if I got this right. I'm just going to look at your message. Long the April 80 calls. Yes. Short the March 110 80 strangle. Yes. Okay. So that's going to look a little like this. No, it's not. What's happening here? That's not working. Yeah. Let me just I'm going to just scroll this out a little bit. There we go. So first of all, also verify for me, if you could, what your cost basis was. Just do me that favor. All right, so maybe I may be getting a market data problem on the feeds. That could be part of the problem what I was having on the options play side, as well as our own software. We're not going to have time to diagnose whether there's a market data problem after the close, so we'll check that in a second. It's okay, because one of the things I could also do is just draw you a picture, but it's not going to be very pretty if I do that. I like to use these applications because, number one, they are able to capture effectively real-time prices. So we are long the April 80 call. We're going to take a mid-might. We're short a put. We're short a call. These were both in March. You guys are getting a little bit of a walkthrough on how to, so short the 80 put. Do I have that right? Okay. Yeah, I think that's about right. So we're getting something like, looks a little bit like this. Yeah, I mean, see, and we just got some news out of these guys, so let's take a look at where vol is too. Oops, let's get rid of, we're just going to do today's. I don't need any of this other noise. So we're long April. That's here. That's good. And you're short March. That's over here. Okay. So I just wanted to make sure that we had a vol surface that is consistent with the picture that's being drawn. And that picture is showing, I don't know if you guys can make this out. see if I can blow this up a little. It's one of the reasons I wanted to use that other charting application, just to give us a little bit more resolution. I don't know if you can make this out, but what you're going to see here is that there is actually a positive standstill rate of return. That strangle, that 80, 110 strangle is going to decay, and this is not surprising. You're short more options than you're long, and it's also the a near expiration. It's going to decay more rapidly than the longer dated one is. So, okay, I'll go along with that, with the proviso that you are taking some long deltas here. So that's the next question. Is there, how do we feel about that technically? We're treading right into an interesting area maybe. Let's see, let's expand this a bit. I don't know what level, how you identified your levels. It's not a bad one, right, to make this play. Unfortunately, there's a little air under there before we get to our next spot. But in general, I do, for stocks that you like, I am generally in favor of, working your way in something that gives you some positive carry. I would not, for example, sit there and say, okay, we have no upcoming catalysts. We've just broken below long-term moving averages. And now I'm going to sit there and go buy calls at an elevated implied volatility, hoping that the stock rebounds when no obvious mechanism for support has been found. The only downside I would say is that because you're shorting the puts basically right where the stock is, you're kind of catching the falling knife. You've said, okay, I'm going to draw a line in the sand, and I think this is where I'm going to buy the stock. When I'm not 100% sure that I see what, $80 is, there is a line here, but it's violated that already. It does feel like there's a little bit of more potential air underneath this one. And also, we're only one day into a catalyst, and sometimes you like to wait for a few days. But, the good news is that from your perspective, the implied volatility is, even if the stock settles in and if it has a couple more days of weakness, the implied volatility is going to be lower in your net short premium. So I guess there's a little bit of an offset. So I don't hate it. I just might have chosen a lower strike put, that's all. What's your opinion of MicroStrategy's ability to hold at 100? So you are... Oh, you're asking about the preferreds, I think. Well, they can do it. I mean, it's not like they don't have the ability to eat into their reserves. But it's, here's the thing. I would prefer, if I was a strategy shareholder, even maybe if I was a preferred shareholder, I might say, you know what, can we not pay those preferred dividends until Bitcoin recovers a little bit, preferably above our basis? I'd rather that, right? You don't want to get long anything on the cap table when they are going to be paying out dividends on the preferreds and may be compelled to sell some of their treasury holdings at a level that's below their cost basis. And frankly, look, I don't run the company, and maybe it would have diminished the appetite for the preferreds if they had done this, because some people are probably buying the preferreds because they're thinking, well, these are more of a guaranteed way to collect distributions from it. But I might have indicated something like that if I was, part of the company's management, to say, look, our intent is to capitalize on our long-term bullish view for Bitcoin. We want to be able to provide distributions to people who invest. We have different things on the cap table that people can invest in. You have the busted converts. You've got busted only because, as Mark correctly pointed out yesterday, they're very far out of the money to the convert strikes. But I might have said something like, if we get below a certain level relative to our cost basis, we may suspend the dividend to avoid diluting shareholders, including the long-term potential opportunity for the preferreds. But they will know better than I do, why people got into them. That's just what I think about it, though. Okay. All right. You're using a Bloomberg terminal. Will AI make this expensive terminal obsolete? Well, first of all, there's some AI that's built into it now. They're not caught up with everything else that's going on, but I think the answer to that is no. Part of the reason is that I pull a lot of data out of this. I mean, as soon as AI makes me obsolete, which it probably will, and maybe sometime soon, people like myself rely heavily on the terminal because we use it for a lot more than what I'm showing you here. So I have models and spreadsheets that just get fed by data that comes into this thing all the time, and I cross-check a lot of other stuff. We use it for even just for trading. There's a trading platform in this. The traders use Bloomberg. So when they fire orders in and we get fills back, it's all in here. I would show you that, but if I did, then I would be showing you orders that we actually did, which I can't do. But we use it for a lot more than what you're seeing here. I mean, we use it even for, this is going to be of almost no use. I mean, it's even a messaging platform. The reason I'm going to say it's no use is that these are alerts that I'm getting from compliance and this and that. So if an order comes in and it says, oh, it's you have to double check some rule on this order, you can see I'm getting messages from this thing all the time. It's used for a lot of stuff, not just what I'm showing you guys. So yeah, I mean, of course, AI is going to threaten a lot of things, but I imagine that it's not going to put them out of business immediately. All right, so, I've gone over the hour already. So I think I'm just going to quickly scan here. Yeah, there may be some other questions, but I just want to make sure that I respect also not just your time, but also that of our crack production staff back on the East Coast who have other time-pressing obligations to attend to, not just these live streams. One other thing, I'm just going to leave you guys with this as a thought, because it was something we tossed around today. And I'm open to feedback on this. One thing we could do with these sessions is we could make them more curated, meaning that there's more of a sort of a presentation flavor to it, maybe for the first 10, 15, 30 minutes. To do that would require a much larger investment of time on our side, which means we would do them less frequently. So maybe once a week on Wednesday, more of sort of a presentation followed by a shorter Q&A. I don't know whether that appeals to people who are watching more or less than what you're getting now, but I'm open to suggestion. So if you have suggestions on that front, not into the live chat, but into the comment section, please contribute your thoughts and let us know what you'd like to see and how you'd like to see it. Just understand that if it's going to be a little bit richer on the presentation side, that takes more time, and we would probably either do less frequent sessions or take less Q&A or some combination of both. But in the meantime, as always, I appreciate your time and attention. I appreciate your questions, and I appreciate you guys watching. And I'd also appreciate a like and a subscribe if you have not already done so. And please come back next Monday, 4:15 Eastern Time. We'll see you soon.